Last week, we were focusing all about how to capitalize on the next great wealth transfer that I personally believe it's probably somewhere on the horizon now. It's been a very long bull market. I'm not predicting doom and gloom. I'm not actually going to try to call when it is. Fortunately, I have the signals. I don't need to actually make those decisions, but at some point it's going to happen. But today I want to talk about what happens when the underlying asset class itself is just going through troubles. Maybe not an all-out crash, but something that you would definitely want to avoid. So let me call up a little presentation here. Just a quick reminder, this is our total portfolio solution. This is all four of our tactical strategies. So we've got an option strategy, and then we've got three what I call tactical rotation through volatility targeting. And then two of them, of course, because they are quite aggressive, there are people out there that have higher risk tolerance than I do, and you might just want to focus on the two highest returning strategies. But tactical rotation is pretty simple to explain. This is our tactical volatility strategy, and we're using volatility metrics to determine when to hold these different assets. So during really stable calm markets, of course, short volatility is going to do really well. We will be holding the SVXY. But when volatility is elevated, this is arguably the most important part of the strategy. It's what you're going to rotate into when the short volatility trade isn't working. Because there is going to be periods where it's just chopping around and not doing much. For us personally, we're holding the GLD gold. And then on rare occasions, only about 2.5% of trading days, give or take, we will be in long volatility and trying to capitalize on an all-out market crash. But today I'm going to be focusing on this safety position and why we use it and why it's so important. So in last week's live stream, I talked about how this is just a backtest of the strategy to 2008. We actually launched live in 2012. But because it's 100% systematic, I can just drag the backtest. And this is the 2008 financial crisis. So obviously, if we get an all-out market crash, there is definitely an opportunity to make a lot of money. And like I said, preserving your capital, making money, and then buying into the stock market or perhaps into the real estate market after everything has collapsed, this is the great wealth transfer. But today we're going to talk about what I would say equally important and something that happens a lot more often. So this is the SVXY. This is the minus 0.5 times short volatility ETF. This is the one we use in our strategy right here. Stable markets. And we can see here, it's really struggling lately. This is the last year, and it's actually currently down 26%. And it was down nearly 40% at the bottom. And that almost happened again very recently. So the short volatility trade has not done very well at all in the last year. But what I want to talk about today is how useful is it for our gold positions when we move into safety? Because this is really going to make or break your strategy. As I always say, everybody and their dog knows what to do when the stock market is calm and stable. You're either net long equities or you're short vol. It's very easy. Everybody's making money. Everybody's a genius in a bull market. But what are you going to do during periods like this? That's really the differentiating factor here. And so what we're looking at here, this is our live tactical volatility strategy in green versus just the SVXY buy and hold. And this is going back to July 24th, 2024. So it's actually going back to this period where we move to safety. These are the live results. Now we can see since July 24th, the SVXY itself is down almost 20%, 18%. Now our strategy, because we have the ability to rotate through those safety positions, we did actually get one single long volatility position, but it's been almost entirely gold. We actually have the ability to rotate out of the asset that's not performing well and still make forward progress. Now, obviously, you can't turn garbage into gold. The SVXY itself was down almost 40%. We're not going to be able to turn that into big profit or anything, but getting something close to flat is really beneficial. And this is happening here. We can see these are just the GLD gold positions within the strategy. And in the last 9 months, we've actually held gold about 60% of the time. You can see there's a few flat periods. That would be when we were holding the SVXY. Again, this chart is only showing when we are holding the GLD ETF. And during that time period, these positions are actually up over 20%. You can see it here on a chart as well. If we just look at the SVXY, this is for the last period. Pretty ugly, right? But then if we look at the GLD, it's actually done very well during that same time period. So the fact that we can actually rotate in and out of these positions based on those volatility metrics, I have managed to make a profit in the gold and largely sidestepped this major problem in the SVXY recently. Remember, volatility ETFs and the stock market itself, while there is a correlation there, they are based on different markets and they can deviate wildly. It just so happens in the last 9 months, the S&P 500 has done far better than the short vol trade. Well, of course, if you want to make a long-term profit, you have to have a way to actually still make money, even though the underlying security isn't fully cooperating. If we look at the SVXY long term, of course there's going to be plenty of periods where we are just making that easy money. But again, that's what anybody can do. That's not the skill set you need to succeed. What you need to be able to do is avoid these terrible periods. These are the drawdowns in the SVXY. You can see 2 of them at 70%. But plenty of them at 30 or 40. That's really the value add for a tactical investing strategy. When everything is cooperating, you just try to participate. But when it's crashing, that's when you can sidestep to safety and really make forward progress. This is why our strategy, even though the SVXY has gone through multiple periods of real underperformance, we have still managed to keep moving those chains down the field and keep making small profit along the way. You really can't afford to take 60 or 70% drawdowns. That's just not going to allow you to make forward progress. And unfortunately, most people who trade volatility, that's what they end up doing. They make really good profit in good times, but they tend to give about half of it back in the bad times. 2 steps forward, 1 step back, you actually spin your wheels that way. We try to keep those drawdowns as low as possible so we can actually continue to make forward progress. And again, looking at that chart of the SVXY, even going back further, you can see recently here, it actually touched the same point it was at in June of 2023. It's made almost no progress in a very long time. But our strategy, because we are able to utilize those gold positions, we have actually made a decent profit in that time period. And another example really quickly here I can show you, this is our other strategy, the defensive rotation. This is our other aggressive strategy. This one is tactical rotation as well, but it's using entirely different volatility metrics and a different suite of underlying assets. So the bulk of the performance is coming from the 2x NASDAQ ETF QLD. And then this one moves into safety utilities and then cash during those extreme periods. Now this one, again, I'll just go through this really quickly, but you can see the QLD in the last 9 months or so, it recently touched the same point it was at all the way back in March of 2024. Just in the last few days, it's bumped up a little bit, but it's basically the same point it was at a year ago. But again, through tactical rotation, our strategy is still able to push up, and we're quite close to all-time highs. We've actually made over 20% in that time period. So our performance doesn't have to suffer when you get these periods like this. A buy and hold investor probably thinks they're doing great right here, and then they lose it all. And then it takes a while, and they build it back, and then they lose it all. And who knows, this market crash might keep going. The market is pretty uncertain these days with all this tariff stuff. We don't know what's going to happen. But the point is, tactical rotation strategies are what keeps you going forward when the market and when your underlying asset that you're trading maybe isn't. So both of those situations are, I would say, equally important. Once every 10 years or so, we're going to get a massive market crash. And of course, it's going to be beneficial to be that person that not only doesn't lose their money during the crash, but perhaps even makes a little bit of money. And then you're in an excellent position to really capitalize on that difference, that plus-minus gap that occurs during every recession. The rich people get to accelerate because they've got capital on hand to get in there and take advantage of it. Most investors don't have that, so I want you all to be there to capitalize on that opportunity when it comes. Maybe it's this year, maybe it's not for 3 or 4 years, we don't know. But that second situation, there is also times, even within the context of a bull market, when your underlying asset class is just not performing well. Bitcoin is the same thing recently. We've got our Bitcoin strategy that I shared a few weeks ago in a live stream. Bitcoin's been going down a lot, but we've basically, in that strategy, I've been in fixed income. So you don't have to suffer when the underlying asset does if you know how to rotate into safety. So tactical rotation through volatility targeting. Of course, if you tune into my live streams, you'll hear me talk about that a lot. It's really what's going to keep you making forward progress. Essentially, it's all about making sure you're always within striking distance of that all-time high, within your own strategy, regardless of what the underlying market is doing.